You don't need a 20% deposit to get started in property, and I'm gonna go and break down some really good hacks for you to get started in property, but also scale up that portfolio so you can beat 99% of investors in Australia. If you're interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now, I've been buying real estate personally for about 12 years and I've purchased over 2,000 properties for clients. So I know a thing or two when it comes to targeting the right areas, targeting the right price points, and looking at all of the data. I want to be here to simplify it, to give you the essence of how this all works so you understand at a very high level, what is it that we're trying to do? Now let's jump straight into it with some tips that's going to help you practically get ahead. Number one, learn what lender's mortgage insurance is because it's an accelerator as soon as you know how to use it and a villain if you don't know how to. So lender's mortgage insurance is effectively an insurance premium you have to pay because you aren't paying 20% as a deposit. Now, traditionally, what we've known here in Australia is if I want to go and buy a house, we've been told you need a 20% deposit plus closing costs like stamp duty and conveyancing and things like that. So I say, okay, if the median house price is $1 million, I need $200,000. All right, cool. I'll see you in about 10, 15 years. And then when you finally go and save all that money, you wait 10 years to do it, you struggle eating 2-minute noodles and you get there, you realize the property prices have gone from $1 million all the way up to $2 million. Now guess what? If you need a 20% deposit for that, you're back to eating 2-minute noodles for the next 5 to 10 years. And that is why we have such a fundamental problem here. Because the price of property relative to our income growth, it just doesn't make sense. So if in 2025 or 2026, you still believe you need a 20% deposit, you're being left behind. Because people are going out there with a 10% deposit to go out there and purchase property. When you actually run all the numbers, your cash on cash returns a lot higher when your deposit is lower. So if you're going out there and say, okay, I've got 20% deposit, I can buy one property, or I can use that and split it into two by buying two properties at 10% each, you're gonna outperform so many investors because you've taken that option of diversifying your risk in two different properties, but you're also purchasing really good quality real estate. And that is the key here. If you purchase really shit real estate, nothing's gonna help you. But this is allowing you to get into the market faster and allows you to compound your wealth even faster as well. Number two is borrow like a pro. I can tell you now, hand on heart, the pros or the high net worth individuals are not going to the bank. They aren't going to the same bank they've been banking for 15, 20 years. They go out to a specialist that does this day in, day out. And they say, look, I do my job really well. I don't know what your job is. Walk me through the best policies out there and find me the banks that are going to give me the best interest rates, but also give me the best valuations, which allows me to take out that equity to go again. And believe me, the same property can be valued by 4 different banks. They could vary by $200,000, which is crazy to think. This is still relying on valuers and real people. So you've got different perspectives. That's why there's such a big difference around the valuation of a property. You're not just looking at interest rates, you're also looking at which bank is going to allow me to scale my portfolio and what policies suit me. And you need someone who specializes in that. So if you go out and get a mortgage broker versus going to a bank, you're going to outperform the market because that person is specialized. Now, the other point that most people overlook is with a good mortgage broker, they will know tips, hacks, and skills to scale up that portfolio more than the average person. And if you get a really good one that's in the top 1%, they'll know how to structure things, know exactly what the banks are after, and how to get you positioned for the best outcome as an individual. The guys at Refine Loans are the ones that I recommend. I'll leave a link in the description box below. Book in a free call and understand your position. I've had so many conversations with them where they've had people with a broker come to them for a second opinion and they've left that broker to come across. Purely because just like buyer's agents and brokers, there's so many out there. And if you go on LinkedIn, they're everywhere. But the reality is you want to be dealing with the top 1%. And that's the type of clients that we want to be dealing with as well. Going out, scaling up your portfolio is not for the average person. So if you want to be average, definitely don't contact me. If you want to be in that top 1% of people knowing what they're doing, have financial freedom, can retire early and be work optional, then you definitely need to go and book in a free call. Number 3 is on the topic of mortgages. Understand the power of interest-only loans. Now, I made a detailed video about interest-only versus principal and interest and why there's such a big difference in terms of your long-term wealth. Definitely go check out this video here. But what I want to focus here on is to make you understand that what you've been taught about debt is completely flawed. We have a lot of trauma and you may have been watching a few of my videos, so now you're starting to get what I'm saying here. But I got taught the same thing. In fact, on my first couple of loans, I was like, yeah, I'm on interest plus principal. I don't want to have all this debt. And then I realized that actually the debt there is my actual asset. And what I mean by that is that debt is actually losing its value every year. So the price of property goes up because the currency is losing its value and we've got inflation and the hurdle rate. So the value of the property goes up, but the dollars or the debt that's there is now deflating away. So in 15 years time, when the median household wage is $1 million, and yes, I believe it will be, then you can easily go back and just pay off all your debt. And while you might be thinking that's not possible, let's just take a look back maybe 20 years ago, where the median household income was maybe $40,000. And the debt they took on at that time was about $400,000. So it sounded like a lot. But when you're now making close to 100 to 150K, you could fundamentally pay that entire debt off. Even if you didn't pay a single dollar for the last 20 years, you could pay that off in a few short years. And that's exactly the mindset you need to be in, is go out there and say, how can I acquire my assets? And then have a debt reduction strategy later on. You need the right strategy. You go wealth accumulation, debt consolidation, and then get to lifestyle, which is where you can live with debt, but have really good income coming in passively. Number 4 is understand how equity works, because if you understand equity, you're going to be able to go and compound your wealth, get to properties 7, 8, 9, and 10 before most people can save enough of a deposit for their second property. Now, we've got a lot of clients at Search Property now getting into their 5th plus property, which is really exciting because I see the numbers and I see how their portfolio has been performing, and they're happy to continue paying a buyer's agent fee because they're going, well, you've got me the results so far. I have no involvement and I can go in, continue living my best life, and you guys make me a shitload of money. And the reality is, it's not just about picking the right properties. You need to have that with the right team, the right structuring, and the right strategy around, hey, do I need to offload this property to get into a different market? Am I buying in the right market cycle? And these are the things that you need to consider as well. So when you're going out there and taking debt, and then you're using equity from that debt on that first property, you need to understand what you're doing, because you can get yourself into so much hurt and so much pain if you do this wrong. That's why you need the right people around you as well. So I've got 2 more here. Number 5 is rent vesting is the only strategy. I'm going to go out there and say that for most people watching this video, if you're under the age of 40, you need to be rent vesting. And if you do this well, you can build out so much wealth, but also still enjoy your lifestyle. Now, it could definitely apply to people still buying their own home, and maybe you bought your property 5 or 10 years ago, so you got a bunch of equity in there. But now you're tied to the one place, and often what happens is after about 5 or 10 years, you need to upgrade. You might need to renovate, or you might have seen your friends go out and buy a new place, so you're like, hey, maybe I want a new place as well. What I advocate for is options. I don't care if that means I have to go and rent somewhere. I don't care if that means I have to go and take up another job or a side hustle. I just want more options. And that's what you should be striving for. Whether it's real estate, whether it's shares, whether it's Bitcoin, or whether it's you just saving your money, you want options. Right now, you're fit, you're working, you're able to work. Maybe you like your manager. Hey, I could do this for the next 20 years. But what happens if your company shuts down? What if your manager leaves? What happens if you just don't have a passion for what you're doing anymore? Maybe they change from a hybrid model where you're getting to work from home and they go, maybe you need to come in 5 days a week. At that point, you're gonna say, shit, I wish I made those changes 5 to 10 years ago. Now, what I advocate for is options, right? So you may decide that that is the best place to work, and it might be for the next 20, 30, 40 years, and you're happy. You're like, I don't mind, but at least you had the option. And chances are that if you have the option in the back of your mind, you actually act differently. Now, I'll give you my own personal story is I would never have left the first job and the pay that was given to me, the wages that I was getting paid weekly, which is insane. It doesn't really happen now. You get paid monthly and then you have to budget, but I was getting paid weekly. And I said, why would I now give this up to take a potential risk on myself and take a bet on myself to actually make more and do something I love? Now, fortunately, it's worked out, but I know I had more confidence making that move because I had a real estate portfolio and a machine that I was building in the background. I knew that even if I screwed up the next 5 years, I had a machine that was growing in the background. And that would then allow me to go out and say, okay, if I needed to, I could sell one of those properties. I would have made up for the gap or the shortfall of income that I made, but at least I tried and I know what was out there. That's why I think rent vesting is the option, especially if you're under 40. And finally, ignore the headlines. Forget that there's a new market crash, that there's a new geopolitical war, there's an alien spaceship coming to Earth. Focus on what you can focus on. Focus on what you can control, because where your attention flows, money flows. So with that in mind, what you want to do is have a really robust strategy, something that accounts for a conservative nature and also the more riskier option. Number 2 is look at base cases as well as bull cases. Number 3, the emergency fund is a non-negotiable. You don't want to be selling your property or your assets because you need the money. You want to be allocating money that you can actually put forward, but you want to do that with an emergency fund. That means you can take care of any emergency that pops up and your asset portfolio continues growing in the background. And finally, get yourself a team because going there alone is going to be so hard. And I know this for myself because for the first few years, I didn't really have a good team. I went out there, bought property, used to spend hours and hours stressing about it, especially when things go wrong. And guess what? Things will go wrong. But if you have the right team, people with experience, they're going to say, cool, firstly, let's manage your emotions. It's going to be okay. And the second part is they'll know strategies as to how they can go and find solutions. And that right there is probably the reason why I've been so successful over the last 5 to 10 years. I'm a work in progress and I will always be a work in progress as I try and become a better version of myself. But I can only do that when I'm in the right environment with the right people. So hopefully you're listening to this video and have enjoyed this. Subscribe to the channel, share it with someone that needs to hear it, and I'll catch you guys in the next video. Thanks guys.